Welcome to ETF Edge, your go-to place for everything exchange-traded funds. The chaos in Ukraine continues, but so does the chaos in the trading community. I'm your host, Bob Pisani, everybody. Where are the inflows and outflows in the ETF community? Let's talk with Arnie Nowak. He's the head of Systematic Investment Solutions, the Americas for DWS. They run the X-Tracker suite of ETFs. Andrew McCorman is the managing director at Wallach Beth Capital, and Charles Rotblatt is the vice president of the American Association of Individual Investors. You know, guys, I can't think of a time when there are so many macro issues for investors to address. Inflation, Ukraine, China, and the Fed hiking rates just the most prominent. Andrew, your specialty is the execution of large blocks of ETFs in and out of the marketplace for insurance companies or pension funds. How are your clients managing these risks, and what are you telling them to do now about Ukraine and the inflation issue?
So obviously we're seeing a lot of trades, a lot of large blocks. Today we saw a large IEMG, which is emerging markets outflow into GOVT. So they're doing that. They're flight to safety. I mean, treasuries may not be the best place, obviously, to get a return with everything going on in the U.S., but they are definitely risk off at that level. Yeah.
So Arnie, you run several Europe-based ETFs, including several that are currency hedged. Several of them were 15% or so off their recent highs. Tell us about Europe. Is Europe pricing in a recession over there? And can you talk to us about the value of using currency hedged investments? Because I know that that's one of the specialties for DWS.
Yes, thank you, Bob. Yeah, certainly the flows into European ETFs have been interesting this year. Year to date, we're still up around about 100 million in terms of flows across the market in European equity ETFs. However, over the past 2 weeks, flows have turned significantly negative. What we tend to say to our clients is it's very much worthwhile knowing about your risks, knowing about what type of exposure do you hold with your ETFs, because as you just said, Bob, currency hedging or not currency hedging really matters. If we look at the current situation in Europe, equity markets are down, but so are currencies against the US dollar. So when we in particular look at the Eurozone ETFs, the unhedged part underperforms the hedged part by almost 6% year to date. So investors, unfortunately, who didn't hedge their currency in the beginning of the year received a bit of a double whammy here. So it really is worthwhile knowing about the risks in the ETFs.
Yeah, you know, Andrew, he makes a good point. We never talk about this, but he has the DBEF, which is the EFA, Europe, Africa, Far East, hedged equity. MSCI essentially tracks the same indexes, but the unhedged one is down much more than the hedged ETF here. EFA is the hedged one.
Yeah, the ETF community has done a great job of putting these products out. Arnie will tell you, this product has been out. And it's fair to say maybe without the turmoil that we're in right now, it was more of an even performance. But you have to pay attention. As soon as something happens, and we're going to have inflation with this U.S. dollar, you absolutely must hedge. So it's a great way to change it. And you're keeping the same exposure. You're just hedging, which you do in a volatile market.
Yeah, it's a very good piece of advice. Arnie, you also run the China A-shares ETF, which is a basket of stocks that trade in mainland China, A-shares. What kind of flows are we seeing in those particular funds? And can you explain some of the very wide discrepancies in some of these China ETFs this year? So your fund, A-shares, ASHR is the symbol, is down about 12%. But the iShares MSCI China, the symbol MCHI, also a basket of China stocks, is down twice as much. It's down 26%.
Yes. So, Bob, again, sort of in a similar vein, it's really worthwhile as an ETF investor knowing what is actually in the ETF. As you just alluded to, ASHR holds domestic onshore Chinese equities. Of course, they haven't done as well as probably some investors have hoped. We saw at the end of last year fairly decent inflows into our product. Those have stalled a little bit and to a little bit of a degree reversed over the last 2 weeks. However, performance has held up, especially when comparing to some of our competitors. And so what I mean by knowing what's in the ETF is, especially when it comes to exposure to China, there is a lot of different options out there. You can invest, of course, via ASHI in the domestic Chinese companies, you know, let's say the 300 largest onshore equities in China. Or you could use an alternative product that invests in Hong Kong listed stocks or even in New York or London listed stocks. Of course, with the SEC and the ongoing discussion around financial disclosure requirements here in the US, and the emerging talk around potential delistings here from New York, from the New York Stock Exchange, some of those companies are receiving a worse treatment from investor sentiment and standpoint than onshore domestic Chinese equities. So that kind of differentiation can potentially explain some of the performance differences we've seen year to date.
It's really kind of remarkable, Andrew. You think these stocks are fungible, you know, they should trade the same way in mainland China and Hong Kong and here, and yet there is a differential. Stocks listed here, China stocks, down, different kinds of regulatory pressures that we're seeing.
There's a lot of risk on the duly listed names. I do like that those are the mainland China stocks. And again, it just comes down to a percentage of allocation. The large companies that we deal with, sure, they have 2-3% in China. That's not going to hurt them. But as an individual investor, do you really want to sell your Netflix and take a big bet on China right now? I think there's a lot of risk in that.
Well, what kind of allocation are you recommending to these big pension funds, the U.S. pension funds, right, and U.S. insurance companies? They have global asset allocations now, too. Are China stocks investable or uninvestable at this point?
What are they telling you? I think the smart play is Europe. His hedged Europe is going to do really well. Countries where you can still get commodities weightings, right? If a company produces commodities, you can see that those are not performing, are performing better than tech heavy, like Asia can be tech heavy. So.
Yeah.